All right, I'll begin now, just so we could kind of go through, start some of the interest slides, and then I will leave it open at the end for some questions. And so obviously I encourage people to come up with questions and of course I'm happy to answer them on the webinar and then of course, even offline. Yeah. So this webinar really focuses on best business setup, although I also really just trying to go into the basics on individual, and then we'll go into more on like the business side. Just to give everybody a bit of just kind of background on everything. A lot of there's sort of like standard expat strategies that we'll talk about, the foreign earned income exclusion, foreign tax credit, treaty benefits, but there's really a lot more you could do, especially people that, have their own business, whether it's a side hustle or full-time, because, in general, the US tax system really encourages, investments and entrepreneurship, right? And so, you can sort of see that when we talk about this. Of course, being an expat adds another layer of complexity, right? And running a business from anywhere, adds the complexity of not just the US tax system, but also the local tax laws and whatnot as well. And I've been doing this for almost 20 years now. Helped thousands of expats around the world save on taxes. A few examples just to sort of think through it would be, switching state taxes from California to Florida or no tax state, Florida, Texas. Again, setting up trusts for asset protection and estate tax planning, doing a tax-free, like a $16,000, Roth IRA conversion. There's something called a backdoor Roth. There's a baby backdoor Roth, a mega backdoor Roth. Even sort of switching your filing status, right? A lot of expats that are married to non-US spouses generally think, okay, I should need to be married filing separately if I'm not going to report my US spouse. However, if you do have US kids, then you could file as head of household, right? And then that essentially is way more advantageous than filing as married filing separate. I've even seen big four firms, PricewaterhouseCoopers, Deloitte, mess that up. And then, of course, finally, just like what is the right business structure for saving on self-employment tax, et cetera. So, my background, I used to work at the Big Four, then started this company, Online Taxman, over 15 years ago. We help obviously U.S. expats around the world with their filing. Since then, we've also opened up several other companies. One's Global Expat Advisors that really gets into the nitty-gritty of optimization, setting up offshore structures and trusts. Um, and again, we'll go over these strategies today, sort of the basics on the individual tax for expats, and then of course business tax stuff, and again anything else that people throw our way from a question standpoint. So um, the big question is, should I file? Right? That's the first question, of course. And so there is a minimum threshold. It's 14,600 for singles. 29,200 for married filing jointly. These are the thresholds for 24. They're essentially the same for 25, and then $5 if you're married filing separately, right? So again, if you have a non-resident spouse and you're gonna do that, then know that your filing threshold is a lot lower. And then, of course, do you have to file a state tax return, right? And it really depends on if you have ties to your former state, right? So a lot of what we do, especially for people that are even retiring abroad that aren't going to have active income to do the foreign income exclusion, should really switch states, meaning, be a resident of Florida or Texas or Nevada, no tax state, right? Get your driver's license there, get your voter registration there, and avoid state taxes, right? And in particular with not only high tax states, but states that are very aggressive, right? Such as California, Virginia, Massachusetts, North Carolina. Those are some of the more aggressive states. And so it is important to cut ties with your previous state and show ties with, said new tax-free state. And just as a reminder, whether your income is sourced of US or abroad, even if you pay taxes locally, you're still required to file your US tax return if you meet these minimum thresholds. So the good news is that there are tax provisions for avoiding double taxation for expats. Um, the first one is the foreign earned income exclusion, right? That allows expats to earn up to $126,000 free of U.S. income tax. Actually, for 25, it's 130. It goes up every year. And so, in order to qualify, expats must meet either the physical presence test or the bona fide residence test. So, this is an and or. You don't have to do both, right? Only one. And I think I see a lot of accountants, US accountants that are good accountants, really be misinformed. Like literally, it happens almost every week where the US accountant is misinformed on what qualifies, etc. Um, so the first qualification is that it needs to be foreign source income, right? That means that it needs to be earned. So it needs to be performing the services. So any of this passive income stuff like capital gains, dividends, rental property, pension, this is not considered earned income, right? You're not physically working, it's passive income. And the other definition is, where are you actually performing the services, right? So if you're performing the services outside of the US, that is foreign sourced income, right? That is, so it doesn't matter if you get a W-2 from a US company, you have your own US company, LLC, S Corp, whatever, you are performing services outside the United States. And literally this happened this week with somebody who's in my entrepreneur group who the accountant said, well, you're domiciled in Nevada. Well, just because somebody's domiciled in Nevada, meaning they only have a US address in Nevada, but this person lived in Mexico City. Yeah, this person's earning money outside the United States. Of course, he has a US company. They do events in the US. No problem. He's physically outside of the United States working, and hence would qualify for the foreign earned income exclusion. Um, Again, the physical presence test is 330 days out of a 365-day period. So if you want to qualify for this, it's actually very straightforward, right? You could only be in the United States for 35 days in a year, right? And that's not a calendar year, that's a 365-day period. So you could leave, let's say, July 1st of year one. You're outside the US that whole year. You come back to the US July 1st of year two, right? So then you get sort of like the second half of year one, and then the first half of year two is getting that $130,000 foreign earned income exclusion, right? So you're getting like basically 65,000 of excluded income in year one, and then 65,000 in year two if you come back. Of course, if you end up staying abroad the whole year two, then of course you would get the full 130. So, uh, this is an important thing. So this is more for, again, people that are, sort of nomadic. They don't have a home, popping around. And it's also really important to note that travel days count as a full day spent in the United States. So even if you, let's say, are transitioning from South America to Europe, and you go and spend half a day in Miami, transitioning through Miami Airport, that counts as a travel day or a US day. Or if, let's say you're flying from, Chicago to Mexico, and it's a red eye, or Chicago to Latin America, and you know the clock strikes 12 and you're still in the US airspace, then that day counts as a day, that next day. So it's really important to, leave a little bit of buffer, right? And yeah, and really count your days, because obviously it could be a super costly mistake if you don't, right? You're talking about 25, $30,000. So that's the physical presence test. Now the bona fide residence test, which again you can do also, which is what I do. I live in Brazil, which is basically showing that you live outside of the United States. You have a residency in another country. You don't have to be there 365 days. In fact, the beauty of the bona fide residence is that you can be in the United States really no more than like 3 months or so. But obviously, 3 months or 90 days is more than 35 days. So it gives you the ability to go back to the US more often. Or if there's a family emergency or even a work work conference or work project. Because you're still outside of the U.S. You establish a home, right? You have a local visa, you have a local bank account, you have a long-term lease. You have something, social, cultural, religious ties, right? I mean, anything from a gym membership to a library card. Um, and you could be paying local taxes, you could not, right? It depends, of course, on the local tax situation. But this is a sure way to qualify for the foreign earned income exclusion. Of course, this does not work for digital nomads moving around. You do have to be in that said country. It's not like you have to be in that country for, again, there's no bright line on how many days you have to be in your resident country. Of course, like I would say at least 3, 6, 9, almost a year. But, and because I don't like sometimes people get residencies in a place like Paraguay or Dubai or Panama, and they just need to be there for one day every 6 months, right? That doesn't work. You need to really show that you are in fact living in said country, even if you're traveling a lot to other countries or going back to the U.S. for some time. So, but again, I think the bona fide residency really allows you to go back to the United States for more time. Now, of course, if you go back to the United States for 2 months straight, let's say. Um, you should be that time that you're in the United States working, that would be taxable in the US. So you need to do a little bit of like a pro rata calculation. So for easy math, let's say the foreign earned income exclusion is 120,000 and but you're in the United States for 3 months that you're working. All right, well then that means that a quarter of that 120 or 30,000. So you'd only your foreign earned income exclusion will only be $90,000, right? Because you 3 quarters outside the U.S., 1 quarter in the U.S. So you have to sort of pro rata that. The foreign tax credit is really a dollar for dollar tax credit for taxes to foreign government, right? So again, it could be from earned income, right? You could be again living in a country and paying local tax on your earned income. It could be from any sort of investments, let's say real estate, or you have local bank interests or stocks and you're paying taxes locally first, then you would get the foreign tax credit for the taxes that you're paying locally on your U.S. tax return. Now, doesn't really matter if there's a tax treaty or not. Generally, obviously, tax treaties are better because it clarifies things. But even if if you live in a country that doesn't have a tax treaty, still be able to take the foreign tax credit. And in some cases, foreign tax credit is better than FEIE. Like if you're living in a high tax country, whether it's the UK or Northern Europe, um, it allows you to get a child tax credit potentially in the US or Roth IRAs. So it's always good to have this um, analysis on whether it's better to do a foreign tax credit or foreign earned income exclusion. Now, the foreign housing deduction or exclusion essentially is in addition to your foreign earned income exclusion, right? So it starts at 20,240, which means that basically, and what this is it's sort of the US government wants to level the playing field for people that live in high cost of living countries. So what it says is if you are paying over $20,000 per year in rent or repairs or renting a parking space, et cetera, if those costs are more than $20,000 per year, then anything over that amount you can exclude or add to the foreign earned income exclusion. So let's say, your rent is $25,000 annually. So again, it's over that 20,000 or so amount. So basically, your foreign earned income exclusion for 2025 is 130, and then you add this additional foreign housing exclusion of 5,000. So that means your excluded income is 135,000. The foreign housing deduction is sort of the same thing, but for self-employed expats that allows you to deduct these housing expenses from your gross income, right? And so, as U.S. expats, we're entitled to both. Um, for people that do live in countries with a tax treaty, it does allow the tax treaty essentially does allow for potentially exemptions or reduced tax rates on things like retirement, Social Security, um, yeah, passive income, etc. I'm not going to really go into specifics because really there's so many nuances in each one. But one thing to think through is looking at the savings clause. The savings clause sometimes negates even benefits that are in the treaty by saying, okay, this doesn't count or whatnot. Um, and then also finally, there's something called a Social Security totalization agreement, which really helps you from paying double self-employment or Social Security tax, right? So, and this is different than a tax treaty. So you could actually live, for example, Brazil actually does not have a tax treaty with the United States, but has a totalization agreement. So, if I'm paying tax, Social Security tax in the US, I don't get taxed on that in Brazil and vice versa. So be aware of whether the country that you live in has a tax treaty, does it have a Social Security totalization agreement, and again, that ultimately affects um, your tax situation. Because I think one thing that's I want to stress is that obviously what I'm going to talk about in this presentation, both on the foreign and income exclusion and even on a lot of this business structuring stuff, if you are a tax resident locally, then some of these benefits or structures might not apply because they might not be negated by your local taxes, right? So I think it's super important to be aware of what your local tax situation is and how that coincides with your U.S. tax situation. And of course, like we work with a ton of firms around the world. If anyone needs a recommendation or somebody in pretty much any major country, we have trusted partners. They're not like economic partners, but just people that we work with that are really good and trustworthy. So again, happy to send referrals. Um, Exchange rates is an important one, right? If you are receiving income or paying expenses, again, like rent, for example, then you have three choices on how to calculate your exchange rate. One is the exchange rate on the day that you earned the money, right? So if you got a big bonus or you maybe had a home sale, you might want to use that over your average monthly exchange rate or the average yearly exchange rate, right? And for the average yearly exchange rate, you can go to the IRS website, and they have average yearly exchange rates for most of the major countries. And you have the ability to pick any of these methodologies, but that methodology needs to be the same throughout the return. So if you're gonna do the yearly average for your salary, then you also have to do it for a stock sale or anything like that, right? Of course, you could change it from year to year, but it does have to be consistent in said year. Switching topics to reporting. So, the other side of living abroad, of course, is that might get a local bank account. You might be investing in said country or countries. And so what's really important is knowing that you do also have to report all of these assets. Um, Now, it's not a crime, it's not an issue to have, of course, foreign bank accounts and foreign assets, but the IRS does want to know. And basically, if you have over $10,000 in aggregate in foreign bank accounts, you need to report that to the IRS every year. And when I say in aggregate, what does that mean? That means if you have one bank account and the highest balance is $6,000. And then you have another bank account, and the highest balance is $5,000. And you add them together, that's 11,000. So you've sort of quote unquote tripped the that $10,000 threshold. And so you need to report both bank accounts. And the fines and penalties could be stiff. It's $10,000. So I do really encourage people to of course report this. And a lot of times the banks, if you open up an account and they know that you're American, they will ask you to do some IRS forms that report this. So the banks are able to give this information to the IRS. So again, that's another reason why you want to be just full disclosure. Now the other form, so you have the F bar, which actually is it's actually reported to the U.S. Treasury. It's not even reported on your tax return for the bank account. Then you have another form called 8938. 8938 is reported with your tax return. And as you could see, the thresholds are a lot higher, right? It's, if you're living outside the US, 200,000 if you're single, 400,000 if you're married filing jointly. So big difference there. And then if you're living in the United States, it's roughly $50,000 single and $100,000 married. And so again, a lot higher than the $10,000 threshold. But the reason is that um, the categories is a lot broader, right? So FBR, it's really only bank accounts. And for 8938, it's um, any sort of financial account, right? Depository, custodial, right? Like a brokerage account. If you have shares in a foreign company, if you have a foreign pension, mutual funds, even loans to foreign people, options, any financial instruments, these are all reportable under 8938. So you could see the breadth of the reporting requirement is a lot bigger. So then what's not reportable, right? Physical gold, bars, bullions, anything that's in a vault you don't have access to, not reportable. Any sort of tangible assets like yeah, jewelry, etc., not reportable. Safe deposit box, not reportable. The top one I think is an important one, foreign real estate, right? Because obviously a lot of people that are moving abroad buy real estate. If it's in your name, it's not reportable. But if it is through a foreign entity, right, like a foreign corporation or even an LLC in the US, then it becomes reportable. And then, by the way, if you do have a foreign company and you own over 10% of a foreign company, then there are some, and you're American or green card holder, there are reporting requirements called 5471, which is for foreign companies. And so again, you need to report that. And then finally, if there are any assets that are in the name of a foreign spouse, that's not reportable. So of course, if you trust your spouse, this is a great way to, not have to report certain investments or income or whatnot, because again, it's not in the name of a U.S. tax person, right? Of course, that means that you're not going to file jointly, and your spouse is not going to be part of your tax return. But again, I think that's a great way to tax plan by using your foreign spouse if you trust them. I'll get into PFIX a little bit. PFIX stands for Passive Foreign Investment Company. And so the tests for that are over 75% of or more passive income and over 50% or more passive assets. Mm, and then mutual funds. So like this includes basically mutual funds or international pension funds. So I think the main point of the slide is that there are people that, you talk to, you move to a country to talk to a foreign financial advisor, and they, try to sell you on like these, sexy mutual funds and whatnot. The problem is being an American, these funds are subject to some very punitive taxes. And so I'd really avoid that. Of course, getting bank interest or or owning individual stocks is not an issue, but any sort of fund can be an issue. And so I just do my best to avoid these and avoid the hassle or headache behind any sort of foreign mutual funds, especially because you could probably get the same exposure in the United States via like an ETF. All right, let's go a bit into the structuring side, right? So in the US, you have essentially three types of structures. You have an LLC, that's like a disregard entity. That means that, if I own LLC 100%, I don't have to do a separate tax return. It literally flows through to me on Schedule C. If it's multi-member, there's multiple people, then it's a partnership. We do Form 1065 for a partnership, but again, the income flows into my tax return on my, percentage profits or ownership, and then I pay tax on that individually. So in other words, there's never any taxes paid at the entity level for an LLC, right? It's flow through. Um, Same thing for an S corp. S corps also pass through or flow through, so you never really pay tax at the entity level. I mean, sometimes you do on the states like California, New York. You do have a little bit of S corp tax, but generally it flows through to your personal return. Now, the S corp is great because it limits self-employment tax, and I'll get into a little example later about that. But I think generally speaking, if you have an LLC, if you're making, roughly 50, $60,000 net income, it makes sense to do an S corp. But again, the S corp may not be suitable for people living in certain countries, right? I think you need to really clear what the best structure is for you when you're living outside the United States and what the local tax laws are. And then finally, a C corp, right? A C corp is a separate legal entity. It's taxed at 21%. So, this sometimes is actually a decent structure for people that are living in foreign countries, especially if there's a tax treaty, because they sort of don't touch a C corp because it's already paying tax in the US. Um, if people are doing any sort of venture capital or fundraising, then a C corp is generally preferred. And yeah, it's a great legal entity. But at the end of the day, you're paying the 21% corporate tax. And then because it's not a flow through or pass through entity, then if you want to take money out in the form of a salary, a form of dividends, then that would be taxable. Of course, you could take your 130K salary every year. You could also pay 130 to your spouse. So there's ways to, of course, drain out that money after the 21% tax rate. So again, people that are self-employed business owners, first off, the self-employment tax cannot be avoided with the foreigner income exclusion, right? So even if you are qualified for the FEIE, you're self-employed, you're like, okay, great. Like I get my 130, but you will still pay tax on, yeah, on that money, self-employment, 15.3%. So then again, then you have this decision tree to face. You continue to be an LLC, and in this case, let's say you're making 100 grand tax free, not tax free. Well, you qualify for the foreign income exclusion. You're making 100 grand net as a LLC. You're still going to pay $15,000 annually, or you could elect to be taxed as an S corp, and then you're not paying that full 15.3% self-employment tax on your net income. Right? So how does it work? Let's say you have $140,000 net profit, right? You're paying 15.3% on that whole 140K. So you're paying $21,000 off the bat. Um, let's say that you spend some time in the United States, your FEIE is like, let's call it 110. And so that means that, 110K is tax free under FEIE, but you still have this 30K remaining. again, your tax situation is $29,000, right? So then what happens if you elect to be an S corp? You elect to be an S corp of the 140K, you take a 60,000 salary. Now that salary is still subject to the Social Security, Medicare, FICA, right? So that's 9%, 9K. But then the other 80K is what's known as a profit distribution, right? So it's not subject to the 15.3%. So then you're only paying tax on, this 30K or so that's left over. So it's 8,000. And so again, in this example, by only paying the 15.3% on the 60K versus paying it on the full 140K, you're saving roughly $12,000. So again, it's substantial, and this applies to people either who live in the United States or outside the United States. If you have your own business and you're earning at least like 50, $60,000 net, you should be making an S corp election. Now, um, having your own company and having, in this case, an S corp also allows you to reimburse yourself for business expenses. Right? So one thing that we recommend everyone do is set up an accountable plan, right? And this allows you to be reimbursed for things like um, home office, right? So you're paying, I don't know, let's $5,000 a month in rent. You're using a third of your space, so roughly $1,500. You should be being reimbursed under the accountable plan each month. Right? So you're literally just, the company is paying you back for your, um, your home office or a portion of your home office. Same thing when it comes to phone, when it comes to, health insurance, etc. Your company should be paying you back. And so the accountable plan is a great way to set that up. Um, The qubit deduction, again, it allows you to get an additional deduction for self-employed people, right? So again, for either S corp or sole member LLC, you can get this deduction. Now, I think one thing that a lot of accountants don't do is really this salary optimization, meaning, um, basically, do you take a lower salary or do you take a higher salary for QBI, right? So I think it's important that you do the salary optimization between self-employment tax savings and QBI deduction. I think that's a big thing that a lot of accountants miss. Before we go into offshore business structuring, just to sort of talk through a couple other concepts that um, I think are important for entrepreneurs that have a U.S. setup. One is also the Augusta rule, right? The Augusta rule means that you're allowed to rent out your home tax-free for 14 days, right? So what we do with a lot of entrepreneurs is, you have a mastermind or you have a holiday party or maybe you have a showroom or whatever, depending on what your business is. You rent your house out to your business, right? You look at what's the daily rate to, rent out a venue for a party or a conference or a meeting. Sometimes you have like a team building meeting, whatever. Your business pays you, let's call it $2,000 a day. So you could deduct $2,000 from the business, you receive that money, and because the Augusta rule, you're allowed to do that for 14 days. So basically, $28,000 you could earn tax free and be a deduction on your business. So the Augusta rule, paying your kids, right? People that have kids, even if they're, small babies or toddlers. I mean, if you're doing it for modeling purposes or whatever, you could pay your kids something reasonable. And what I see a lot of parents doing is then taking that money and contributing to like a Roth. So I see a lot of parents that say, okay, pay your kid $7,000 and then make that contribution directly to a Roth IRA for said kid. Um, and just in general, this notion of setting up a solo 401k, right? I think a lot of people sort of neglect the fact that you can do a lot of tax savings by um, contributing to a retirement plan. And so setting up a solo 401k, and that allows you to contribute to both a traditional, right, or a Roth solo 401k. Now, what's the difference? A Roth, you don't get the deduction up front, but it allows you to grow tax free, and then you take it out tax free. Traditional gives you the deduction up front, it grows tax free, and then you take it out, it's taxable. So I think the question is always, well, am I going to make more money now if I do have a higher income now or later when I retire? Right? If you have a higher income now, then yeah, take the deduction, do the traditional. If you have a higher income later, then don't worry about the deduction now and then take it out tax free later. I think the right answer is a combination of both, right? Um, but again, I think it's important for people to know that and do the analysis, right? Pay your spouse also, have them do a solo 401k. Of course, doing a solo 401k setup is really only applicable to people that don't have other employees, because if you have other employees, you have to match that. Um, but again, I think these are sort of some of the tips that we also help business owners think through when they set it up. They set up their company and they start obviously making money or whatnot. Because again, I do think that this is super valuable and really the way to kind of blocking and tackling when it comes to, saving whatever 5,000 here, 10,000 there, and it really does add up. And a lot of it is just being smart about managing expenses and whatnot when you have a small business. So on that note, I will go into offshore business structuring. So again, I think that the first caveat here is that if you're going to set up an offshore business, it really also depends on where you're a tax resident, because a lot of countries don't like, this offshore jurisdiction stuff, right? Like the Caribbean, Cayman, BVI, et cetera. They don't particularly like it. I think you have to look at tax treaties and whatnot. So for example, if somebody lives in Europe, then we're setting up the businesses in generally Malta and Estonia. If they're in LATAM, yeah, sure, we'll do the BVI or whatnot. BVI meaning British Virgin Islands or Hong Kong. So it does really matter where you set up and where you're living. But basically, if you set up an offshore company where it's a US C corp that owns a foreign company and you're running everything through that foreign company and you have no US employees, et cetera, in said company, um, then, and it's of course not being managed in the United States, the first thing is you need to be living outside the US for this to apply. But you would get a reduced tax rate of 10.5%, right? So rather than that 21% C corp, you're only paying 10.5%. Second, then you have the decision, well, if I need the money in the company because I'm expanding, et cetera, then you could keep that in the company. It's a form of tax deferral because you're not taking it out in the form of dividends. Of course, you want to maximize and take your $130,000 salary tax-free under the foreign earned income exclusion, which, by the way, is not subject to any sort of FICA or Medicare tax because you're paying money from a foreign company to you. So you're employed by a foreign company. Of course, you have better asset protection. Um, and yeah, and you get this level of deferred taxes because you pay the 10.5% and that's it. And you could essentially choose to keep the money in there for business purposes. So it's a great structure. I'm going to go into an example. As we saw before, you have a single member LLC, you're paying the full 15.3%. You pay, of course, like the tax on the money above the FIE, 29,000. Now let's do this. So then let's say you, same amount, you have 140K, but you take $100,000 in salary. That's not subject to Social Security, Medicare tax, not subject to FEIE or subject to FEIE. So then you have this 40K that's taxed at 10.5%. So really your tax bill is really only $4,000. Of course, to be fair, if you wanted to take that out, then it would be subject to this 50% dividend tax. But again, that's not even an option, or that's not even a requirement. So, I put $10,000 to be more conservative to show that you're saving $20,000 anyway. But if you don't take it out as a dividend, then you're really only paying $4,000 versus $29,000. So again, it's actually more like $25,000 of savings, if you're doing this example. And again, that's also conservative. I'm saying that the person's in the States for some time, so they're only taking $100,000 salary rather than maxing it out at the FIE rate of 130 for 2025. So I think that I mean, this is something that I've set up. We do it for a lot of our clients. This is really what the Googles and the Apples of the world are doing, by setting up these structures. So obviously, if you want to implement these strategies, there's two ways to do it. Of course, we do give a $69 tax consultation. You could scan the QR code and set that up. You could also go to our website, onlinetaxman.com, and book there. And if you want to get into really the complex heavy lifting of the foreign offshore company, that is actually a consultation with Global Expat Advisors, and that's done directly with me. That's a little bit pricier. It's $250 for the half hour, $400 for the hour. So again, I mean, I'm happy to answer questions and go through this. Um, but for now, I will stop talking. Does anyone have any questions? Michael, do you want to just chime in? I know Michael had his hand raised. Oh, sorry. Now I see the questions. Um, I'm just gonna go from the top. Um, Jonathan asks, can you describe in more detail the punitive tax around foreign mutual funds? I have a large position in a publicly traded foreign mutual fund. Right. Um, so it looks PFIC taxation is sort of broken down into two parts. One is what's known as like excess distribution. So looking at really what the dividends are from the PFIC, and that could be taxed at the higher rate. Um, there's also something called, or there's also the capital gain portion. So you sort of have to look at it, how much money has been taken from the foreign mutual fund, and then what is the capital gain on it. Also, I mean, Jonathan mentioned that it's publicly traded. So I mean, if it's traded on the US stock exchange, obviously, then even though it might be like a foreign company, like an ADR or whatnot, then of course, like it's still subject to, it's not considered a PFIC. But to your point, Jonathan, if it's traded on a foreign exchange, and it's a mutual fund, then um, and there's distributions that are being made from that, then yeah, that would be taxed at the highest rate. And then also um, there'd be a capital gain tax. Of course, if there was any foreign taxes paid on that, then you would get the tax credit in the United States. Next question is um, are there any aren't there other considerable benefits of the disregarded entity, such as solo 401k above line contributions you don't get with the S corp? Um, I mean, again, the solo 401k you still get with the S corp, right? So I'm, a real strong advocate for the S corp, right? I think that I've never, had a situation where I felt that the disregarded single member LLC is better than the S corp, except in certain scenarios, for example, where the S corp was not, locally there were local taxes associated with the S corp that made it not valuable, right? And Portugal is a great example of that. Portugal S corps don't work, so yeah. But generally speaking, I always recommend the S corp over the disregarded entity. And let me know if any of these make sense. I mean, again, we have another 10 minutes. I mean, I'm happy to also follow up with questions afterwards. So, yeah, please, I want to obviously make sure that everyone extracts value from this. Bart, my understanding is that the QBI deduction only applies to U.S. source income. So you can't take QBI for foreign source income that you are excluded under FDID. That is correct, right? So in this case, you generally can't double dip, right? So if it's already excluded under FEIE, then you cannot take the QBI deduction for that income. I see cases where somebody maybe does have U.S. source income or whatnot, and then of course we could take it. But to your point, and this also applies to real estate and other U.S. Businesses. But to your point, Bart, which is a really good one, you cannot take a QBI deduction on income that's excluded under FEIE. And so, yeah. Michael, how can I use the Augusta rule, right? So I think the biggest thing with the Augusta rule is, again, you're renting out your property for 14 days. And by the way, this could also be, let's say you're just traveling and you rent out your property on Airbnb for a few days. That also, is just tax-free income, right? So the rule, which if anyone follows golf, is because people at the Augusta Nationals for like golf would rent out their houses. So basically, you're just allowed to rent out your house for 14 days. So you could do it to a third party via Airbnb, or you could do it to your business. So what I was saying was, you rent out your house for doing an event, for doing a team building, a team meeting, so on and so forth. And because you're renting out your house, your company, you're getting a deduction in your company, but then you're obviously receiving income personally, and you're allowed to do that 14 times over the year. And so I have people that, maybe they use their house as like a showroom if they have whatever, e-commerce products, right? And they have a photographer come over, they take pictures of said products, and yeah, and then they rent that out. So it's just a matter of coming up with the reason why would you rent your house out. Follow up on the PFIC question from Jonathan. It's held in a foreign brokerage or bank account. So again, first you obviously have to report that. Um, it could be obviously reportable under, of course, like 8938 and FR. Um, Are the capital gains higher for this fund than what I pay for holding the same fund in the U.S. brokerage? I mean, again, if it it's tough to say. I mean, if it really truly qualifies as a PFIC, then it is a passive foreign investment company, and it does. I don't think it really matters where the brokerage is. But I guess sometimes I see a lot of people get confused because they get confused by like ADRs or foreign companies. But if they're U.S. Trade in the U.S., then they're not necessarily PFIC. But I also wonder, if this fund is available on U.S. brokerages, then this is not a new issue for them being a PFIC. And so have they, potentially made, there's certain elections that could be made by the fund, that it's kind of taxes U.S. partnership, yeah, QEF election or U.S. partnership election. So the question's also, have they made anything to make it more suitable for U.S. U.S. shareholders? Another one, how is pension income tax in Spain, Portugal, and Italy? Again, I mean, generally it depends on the tax treaty. I think, trying to remember, this is where you're testing like specific country knowledge. Um, I think they're pretty standard. I think Portugal has something for like Social Security. One of those countries has. I think Italy does too, actually. Unlike, how Social Security income's not double taxed specifically. Yeah, so I think, particularly with Social Security, I believe in Portugal and Italy, there are some favorable tax treaty aspects. So Michael says, if I have an Airbnb in the United States, calculating 14 days for my single member company. And again, that is, you're allowed to do that. Yeah, in particular, if you are renting it out for 14 days and it's, sole member LLC, so you're reporting it on your Schedule E. So technically, you can rent that out. Now I'm trying to think if it has to be your primary residence or not. But again, I think you're allowed to certainly rent it out up to 14 days if it's your primary residence. Because generally that's what we do is we advise people to rent their primary residence out to their business. Is a money market fund held at a foreign bank as considered a PFIC? No, no. I mean, for example, in Brazil, there's a lot of, really good interest investments, whatever, like CODs and CDs, et cetera. And so those are not considered PFICs, right? If it's, any sort of interest rate or interest from a bank or bonds, CD, et cetera, then that is not considered a PFIC. It really is a mutual fund is really the shining example of that. And then if you live in a foreign country, say Portugal, but nearly 100% income is from a US based company, your income is then considered foreign income. Is that correct? Right. And yes, that is correct. So you're living in a foreign country, you're earning money, but because you're physically working in Portugal in this matter, in this example, then that is considered foreign income, and you are subject to the foreign income exclusion of $130,000 tax free. And then Victor, which form of an American company owned by a foreigner are suitable for tax uh, trade in the United States? So again, from a non-US perspective, then an LLC, right? The US a non-US person cannot be an owner of a US S corp. You need to be living in the United States or a green card or citizen. So then that's only LLC or C corp. And so in this case, an LLC would be tax-free for non-Americans. Um, and yeah, of course, just as an FYI, so foreigners that are trading US stocks, um, they get no capital gains, and there would be a dividend or interest withholding, and that could be 30% unless you live in a tax treaty country in which you get a reduction. So if you do live in a tax treaty country, when you open up a foreign brokerage, or sorry, a US brokerage account, you should, when you fill out the W-9 or the W-8BEN E form, you should put that you're in said a tax treaty country. Any other questions? Very good. Again, thank you very much for listening, for your questions, for your interaction over the questions. Um, as you saw, and I'll put it up on the screen one more time, but onlinetaxman.com or Global Expat Advisors. So if anyone does have any questions or whatnot, feel free to reach out to us, and we're happy to help. All right. Have a great day.